Hello, welcome to the class on aging in place. In one of the first exercises of this class, the healthcare proxy letter, a number of your alter egos wrote that they wanted to stay in their own home for as long as possible, and that's called aging in place. It comes with its own set of financial, practical, and legal complications. Now, in this class, we're going to look at reverse mortgages, which are a way for individuals who do not have a lot of cash to draw on the value of their home while continuing to live there. The idea being that they're only going to leave their home when they need a very high level of care, and by then they will be eligible for Medicaid. The second topic is home and community-based care. This is a term of art. You can't see me capitalizing each of the letters, but it's a specific legal phrase. Medicaid has long been interested in providing care for the elderly in their own homes, both because it's a money saver and because of the instinct that many of you captured: home is where people are most happy. For many people, the main asset is the house. They might have, say, a house that's worth $400,000, which isn't at all unusual in this area, and a pension of maybe $1,500 a month. And all of that sounds okay, but then you figure in the property tax at $500 a month, and maybe they need to make some modifications to the house to make it livable for someone who's older, and pretty soon you discover they are house rich but income poor. And a solution to their problem could be a reverse mortgage. The main principle of a reverse mortgage is pretty obvious, but I like this graphic, so I decided to show it to you. On the left, you have an illustration of a traditional mortgage in which you're underwater on the house. That is, you owe money on the house, but you pay that off gradually, and the house sort of emerges from below the water table, and eventually you are a full owner. On the right, you see a reverse mortgage. Now, here you're borrowing against your house. You own it in full, and you're borrowing against that asset. Every month you get a check. Your debt on the house rises, and so it starts to sink underwater. And in that sense, you continually own less of the house. But the rules of a reverse mortgage are that you can continue to live there even after the bank owns the whole thing. Okay, here's some more detail on how a reverse mortgage works. First of all, it's a product only for older people. You have to be over 62 to get a reverse mortgage at all. And the idea is you borrow against your home. You can take out the loan in the form of a lump sum, or an annuity, or a line of credit. You have to pay nothing back on that loan until you move out or die. It might be that you live to be 120, and the deal is a very bad one for the bank. That risk, the risk that you live too long, is on the federal government, which insures both the bank and you. Now, you do pay mortgage insurance for that service, so it's not free, but it's the federal government that runs the real risk. It's a loan. You, of course, pay interest on the loan. Eventually, the money you get from the bank plus the interest could be more than the value of the house. And then what happens? You have nothing to leave to your children, but that's really the only repercussion. There is a common but wrong belief that the lender receives title to the home as part of a reverse mortgage. That's not true. After your death, the heirs have to pay off the loan if they want to keep the house, or they can walk away, or the house is sold to pay off the loan, and the remainder, if there is any, goes to the heirs. A final rule is older borrowers can borrow more than younger people. This is partly to protect the bank. If it's not going to get its hands on the main asset, the house, for another 30 years, then the house is not worth that much to the bank because of inflation and so on. And finally, if there are two owners, both have to be covered, and the measuring age, so the cost of the loan, is the age of the younger one. Now, the main reading that I assigned on this topic is an outdated AARP guide. It was the clearest overview that I could find, and on the first pages, I've noted the main changes that have happened since it was written. That is, I've brought it up to date a bit. And there have been big changes in the reverse mortgage market because there were big problems, especially after the 2008 financial crisis. House prices had been high. Borrowers sometimes opened reverse mortgages in order to immediately spend the full amount of the available credit, which obviously defeats the purpose of using the house as a source of income. But people were overconfident. They saw their house values rise. That was giving them extra equity. And then when the financial crisis hit, house prices obviously fell. So did savings and pensions. And having blown the loan against their house, the borrower was left with not enough to live on, or not enough to pay the property tax and insurance on the house, and lost the house. And on the following slides, we'll see how the rules have been tightened up to discourage that kind of bad decision making. Okay, the government introduced reforms. The reforms were introduced to reduce defaults, which protects especially the federal government as guarantor, but also borrowers who are tempted to take out a big lump sum at the beginning of the mortgage and not leave themselves enough money to live in the house or to maintain it. So the reforms are, first, the amount you can borrow is less than it used to be. That increases the likelihood that the sale of the house will cover the costs to the bank, and this in turn protects the mortgage insurer, which is the federal government. Second, there's a limit on how much of the mortgage you can take out in the first year. That's to deter people from blowing it all at once. And third, the borrower is required to clear all other debts on the property and to bring the property into good repair. Now that does decrease how much the borrower can borrow. That is, he may be able to borrow $100,000, but he has to invest $50,000 first to pay off the debts to get there. But again, that lowers the risk to the lender. And then the higher mortgage premiums, mortgage insurance premiums, also protect the lender. And finally, lenders are required to screen the borrowers. They can't just lean on the federal government to bail them out if the borrower defaults. Here are the specific figures for 2019. But before I get there, I should mention the official name for a reverse mortgage, which is a home equity conversion mortgage, or HECM, H-E-C-M. I think the book uses that name. I use it in my notes, so I should let you in on the secret. Okay, so you can't take out more than $726,525. That means even if your house is appraised at more than that, that's the most you can borrow, but you really wouldn't be expecting people with such very expensive houses to be taking out HECMs anyway. You have to pay a 2% mortgage premium up front. That's a big chunk of the value of the house. And you have to pay it at closing. After closing, you have to continue to pay a mortgage insurance premium of 0.5% of the outstanding balance, but those premiums are added to your accumulating debt on the house, and they are due only when the loan matures. Here are the different withdrawal options. I have to keep talking, otherwise the video will move on. First of all, there's the option of a lump sum withdrawal, and there's a limit on this that was mentioned on the first slide, but I forgot to point out that you can take out a maximum of 60% of the loan in the first year. So that's to prevent people from taking out the whole amount and then spending it. You can also take out a line of credit, And that's interesting because you can take that line of credit now, and then when you need it, you can tap into it. And what you haven't used, the value of what you haven't used, rises over time by a predetermined interest rate. So your line of credit actually grows against the house. And then there are monthly payments or annuities, either a 10-year annuity that is a monthly payment that's guaranteed for life, or a term annuity, monthly payments for a specific period of time. But the next slide illustrates that better. Okay, here's an example with some actual numbers. So I began by imagining a $100,000 house, which was hard because the last one of those in New Jersey probably disappeared 20 years ago, but this is just an illustration. Now, I'm imagining this $100,000 house and a 6% interest rate, and I'm saying that the individual will be able to borrow $58,000 plus. You never get access to the whole $100,000 worth of your house. Why? Because the lender has to make money off the loan. It lends the borrower a sum and charges interest on that loan of 6% or whatever, and hopes to break even over the life of the loan. The older the borrower is, the shorter the life of the loan is likely to be, and the more the borrower can borrow. See the next slide. If the interest rates are at 5%, a 62-year-old could borrow 60% of the value of the property, whereas a 75-year-old could borrow 70% of the value of the property. Now, how do I know all of this? There are very simple calculators online where you can plug all of the parameters in and get the figures printed out for you. And I'm going to ask you to do that as part of your exercise for this class. So if I plug in all of those numbers, I discover that the individual, whose age I've forgotten, has an asset of $58,000 to draw against. The options are a lump sum of 60% of that $58,000 in the first year, and the remaining 40% of that $58,000 in the following year. So a reminder, that's not 60% of the value of the house in the first year, it's 60% of the loan in the first year. And then we have the line of credit option, which is very interesting, as I mentioned, because if you don't use it, then the line goes up by a certain amount. And in this case, the line of credit would be $61,900 at the end of the year. Or you could take monthly payments, and again, you can plug this into the calculator and figure out what your payments would be. You could get $1,250 a month for 5 years, or $720 a month for 10 years. Or you could opt for an annuity that would last for the length of your life, but then of course, nothing's certain, and the bank would give you less per month on that kind of a loan, $475 for as long as you live. It's not all that much, but it could make the difference between being able to stay there or not. Well, I can't resist the fun graphics. This one shows that the amount you can borrow against the house depends partly on interest rates. When interest rates are low, those are the green lines, you can borrow more against the value of the house than when interest rates are high, which are the red and the pink line. And as your age goes up, you can borrow more against the house as compared to when you were younger. That's shown by all of the lines sloping upwards. You can also use the HECM to buy a house. That could be interesting if you need to move to a place that is more suitable for your disability as you get older. Of course, you can't borrow the whole value of the house because of the way the HECM works, but a senior aged 70 buying a $400,000 house on June 12 could finance more than half of that, $250,000, with a standard HECM. And again, older borrowers could draw more, younger buyers less. Explain to yourself why. The senior would have to come up with the remaining $150,000 for the purchase price of the house. Note that the HECM becomes due when the owners die or move out. And that moving out can be a bit of a trap. If you move out for more than 12 consecutive months due to physical or mental illness, then the HECM becomes due. So not for going to the beach, but moving into a nursing home. So there is a danger if you move into a nursing home for a longer period of time that the HECM becomes due. Also, you will lose the house in the sense that you have to pay back the HECM if the property falls into disrepair, or you fail to pay tax or insurance or homeowners dues. And in other words, it's critical that the person taking out the HECM has enough money to maintain the property. When you're looking at your monthly costs, you must include the cost of maintaining the house. This is one place where HECMs can come back to bite you. It's no good having a source of income if even with the income you can't pay your property tax. Here's just a reminder of all of the fees you have to take into account when doing your financial planning, especially the origination fee and the closing costs, etc., all of which are going to eat into your payments. And then there's the mortgage insurance. And if you can't pay all of these, then the HECM becomes due. And again, you'll have to sell the house in order to raise the money. One of the exercises for this week's class is to assess whether certain individuals, certain scenarios are suitable for a home equity conversion mortgage or not. And so here, this might be useful to you. Who would benefit from a reverse mortgage? Well, someone who wants to stay in the home but lacks the income to do so, or someone whose mortgage eats into his income, so the HECM can be used to pay off the mortgage and therefore leave you enough money to live on. Now, who does not want a reverse mortgage? Somebody who is already enrolled in Medicaid, because the house doesn't count against Medicaid eligibility, but if you monetize the house, you're suddenly disqualified. Or someone who only needs money for a short time, so then the closing costs are too high for that.